trading against growth stocks. The best type of stock to write a cash-secured put against is most likely regarded as a growth stock, one that has higher volatility, usually over 80 IV. IV being implied volatility, as listed on the broker platform for the options series of the chosen expiration date. IV may be a symptom of, but isn't a direct measure of company-specific risk. It's a measure of price volatility. Price moves around more on higher IV stocks. Due to higher option VIGA, volatility premium, growth stocks pay higher option premiums to option sellers. Growth stocks are most often small companies with lower market capitalizations, in general, listed on the Russell and Nasdaq exchanges. When, due to broader economic influences, there's a sector rotation out of small cap or growth stocks into perhaps what the market perceives as safer, larger and more established value-oriented stocks. Growth stock-heavy indexes such as Russell and Nasdaq will decline, but individual, higher IV small-cap growth stocks, companies that usually aren't yet profitable, are likely to decline even more than their index as the market reprices the risk proposition of these still unproven businesses. In a crash or correction scenario, growth stocks will fall far more in price than value stocks. The growth stocks traded against must be stocks we're comfortable owning at potentially a significantly lower price due to our conviction in the business's longer-term future success through various market cycles, because we could become buy and hold investors by default if assigned on some or even all open trades during a rotation out of growth stocks. Stocks to look for. The large cap value companies of today were all once high IV growth companies. Many are technology companies. Many others use technology, operating, for instance, with artificial intelligence, ground-up built technology stacks to operate in more user-friendly, effective, and cost-efficient ways than many legacy-type companies, where bolting AI onto existing systems tends not to be as effective or efficient as building a tech stack from scratch. Pretty much every part of the business economy will be and is being remade by software. Not only those companies developing software, but also those adopting it at the center of their business thesis, stand to benefit most from disruption and change. Data is power. Bricks and mortar is increasingly becoming a costly overhead expense for businesses when customers, who've grown up online, are preferring the speed and convenience of conducting personal and work, life, business, shopping, online from phone and from home. These are times of newly emerging industries and the disruption of many legacy industries by fintech, green energy, electric vehicles, AI, genomics, SaaS, gaming, etc. We look for a business that we can understand, a company in which we can have high conviction they can and will execute, in an industry or sector that's inevitably going to see future growth, with excellent management, who hold stock in the business, better yet, if they're buying stock to increase their own stock holding. Since they're insiders, that says a lot about their confidence in the business. A business with a strong balance sheet, sufficient cash to fund growth, or the ability to raise capital cheaply, thus not needing to dilute its share count to raise capital, where the stock is reasonably enough valued in the current market, that if assigned on a put trade, we can have a lot of confidence in price reverting back to the assigned strike in the not-too-distant future. Some growth companies may be seen as potential market disruptors. However, being likely to get a good share of a large addressable market is good enough. Growth stock valuations. We want to trade against stocks that are trading at good, preferably cheap, and undervalued prices. Although we're trading the options, not the stock, we still have to protect downside risk to our cash-secured put trades by thorough due diligence to be as sure as possible that the underlying company is solid. Most growth companies are young, newly listed, and generally start out unprofitable. We need to be able to see in their quarterly earnings reports that these businesses are growing as strongly as management has forecast for that quarter and is also on track for the year. Where still not profitable, it's important to keep quarterly track of cash and debt levels and current cash burn per quarter to estimate how many quarters of run rate there'll likely be before the company may need to raise more capital and possibly dilute their stock in doing so. It's important to listen to the post-earnings conference call and Q&A to have management's more in-depth take on the business. Strong growth is 20% plus annual revenue increases, current year and next year's likely growth. We're forecast, as long as the company continues growing as strongly as its market expects, stock price is likely to be stable or rise, more importantly, not collapse. We want to see a young entry into its market sector, growing revenues at a rate that at least matches the annual growth rate for the sector, preferably bettering it, suggesting the business is at least finding its niche or may even have some advantage over its peers. Our aim is to trade against growth companies not only growing revenues strongly, but also with currently low valuations when compared to its peers. To do this, we use the price-to-sales ratio, the company's market capitalization divided by management's current year's forecast of total dollar revenue. The lower the number, the better. A low PS multiple for a growth company might be less than 10, but will depend on how bullish or bearish the overall market is feeling towards growth stocks. The price-sales ratio not only gives an idea of how a company is valued compared to its industry sector peers, but also all other stocks on a watch list of potential companies to trade against. We also calculate another valuation metric that I've called PSG. This is the price-sales ratio, divided by the company's forecast percentage annual revenue growth rate. For example, PS ratio of 10 divided by annual revenue growth of 20% equals PSG of 0.5. A PSG of 1 or less is good, the lower the better. PS and PSG are numbers that provide a basis of comparison to better be able to choose less expensively valued stocks at trade inception for a theoretically greater margin of downside safety. Obviously, nothing is guaranteed. Valuation ratios are for comparison of value, stock versus stock, not stock price prediction. Stocks with low valuations, growing revenues strongly, may be overlooked by the market and will eventually grow in price, whilst more importantly, being less liable to a large stock price decline. Stocks best avoided are those with dodgy fundamentals, or management, or customer concentration risk. Stocks that run up in price on hype, or a story, or those dependent on a binary event, such as an impending drug approval, etc. Trading the wheel doesn't entail finding hypergrowth, speculative, story stocks. It's best to avoid newly listed SPACs and IPOs, as projected expected earnings can be inflated for the capital raise, and initial market valuations are often high. It's hard to know what's a fair market price for a new listing until after a few quarters of earnings. When doing due diligence, the more time spent analyzing a promising business, the greater the risk of opinion confirming bias. It's important to also look at the bear case against a potential stock. A weak bear case can be a stronger reason to trade against a particular stock than a strong bullish thesis, since it's whatever inherent risk factors exist that threaten any given investment. Seeking alpha is a good source of investor sentiment and due diligence-based opinion on many companies by a number of different contributors, along with informed comments from others. Many writers and articles are thorough and well-researched. Safety at inception. Is this stock fairly priced? Is it trading near the low of its range? Does the business have enough cash? Would I be happy owning it at the strike? Is the strike I want to sell at or near support? Choose stocks we feel sure would trade higher than any assigned strike at a later date. In growing industries or sectors that are the future, stocks that are growing at similar, preferably faster rates than their industry or sector average, where insiders have significant skin in the game and shareholdings. Sell cash-secured puts 10 to 20% out of the money for margin of safety. Assume being assigned and feeling okay because you like the stock at the strike.